OTC derivatives. Have you ever wondered how businesses manage risks that aren't easily covered by standard financial products? Let's take a closer look at over-the-counter derivatives and their role in the financial world. Over-the-counter derivatives are financial contracts that are traded directly between two parties. And like derivatives traded on exchanges, these contracts are tailored to meet the specific needs of the parties involved. This customization allows for flexibility in terms of contract size, maturity dates, and the underlying assets. In the context of capitalism, over-the-counter derivatives showcase how markets can innovate and adapt. They provide businesses and investors with tools to manage risks that are unique or not standardized enough for exchange-traded products. For instance, companies facing fluctuations in interest rates or commodity prices can use these derivatives to hedge against potential losses. One of the key characteristics of over-the-counter derivatives is their customization. Each contract can be designed to fit the exact requirements of the parties involved. This is different from standardized contracts on exchanges, which have fixed terms that may not suit every situation. Another important aspect is that transactions occur directly between two parties. While brokers may facilitate these trades, there is no centralized clearinghouse overseeing them. This means that both parties bear the risk of the other defaulting on their obligations, which is known as counterparty risk. Common types of over-the-counter derivatives include swaps, forwards, and bespoke options. These instruments are widely used to manage risks related to interest rates, currencies, credit, and commodities. The market for these derivatives is substantial, with notional amounts often reaching hundreds of trillions of dollars. This highlights their importance in global finance. When we look at weather derivatives, we see a specialized type of over-the-counter derivative. These are used primarily by businesses that are affected by weather-related risks, such as agriculture or energy companies. For example, a farmer might use a weather derivative to hedge against the risk of insufficient rainfall, which could impact crop yields and revenue. In capitalist financial systems, over-the-counter derivatives, including weather derivatives, play a vital role in managing and allocating risk. They help firms stabilize cash flows and investment returns despite uncertainties, promoting economic activity and growth. The ability to customize contracts means that companies can match their risk profiles closely, which contributes to market efficiency. However, the bilateral nature of over-the-counter derivatives has raised concerns about systemic risk, especially highlighted during the financial crisis of 2007 and 2008. In response, regulations have increased transparency and encouraged the use of central counterparties to clear standardized over-the-counter derivatives, which helps reduce counterparty risk. Despite these regulations, many over-the-counter derivatives remain as customized and traded bilaterally. This reflects the ongoing demand for tailored risk management solutions in capitalist markets. The balance between innovation, risk, and regulation illustrates how over-the-counter derivatives fit within the dynamic environment of financial systems. In essence, over-the-counter derivatives are customized financial contracts traded directly between parties. They play a significant role in capitalist economies by enabling precise risk management and supporting various economic activities, including those affected by weather risks. Their flexibility and scale reflected the market-driven nature of modern financial systems, even as regulatory frameworks continue to evolve.